Let me first introduce Dan Rosen. Dan is the founding partner of Rhodium Group, which is an independent research provider that combines economic data with policy insight. Dan has 28 years of professional experience analyzing China's economy. And aside from Rhodium, he is also a member of the Council on Foreign Relations and a board member of the National Committee on U.S.-China Relations. The Honorable Kevin Rudd does not need much further introduction. As many of you may know, Kevin served as the 26th Prime Minister of Australia between 2007 and 2010, and again in 2013, and as Foreign Minister between 2010 and 2012. He's a leading international authority on China, began his career as a China scholar, and served as an Australian diplomat in Beijing before entering Australian politics. Kevin joined the Asia Society Policy Institute in its inaugural president in 2015. So let me pass over to Dan Rosen to give us a snapshot of where the China economy stands today.
Yes, thank you so much. And Kevin, it's great to be with you again here this morning so that we have a good reason to put on our jackets. Days, it feels like a special day. I'm going to share my screen here if I can, and so that I can talk you through a few slides. Kevin, you can be my designated nodder if you will. Can you see that? I think it's okay, great. So I'm just going to touch on a few points here at the top, just pretty quickly, as to the state of things in China. Everything is so fast moving right now, and data like this is always in the rearview mirror. But this is something we call the China Activity Tracker. And to get around misgivings about some data in China, the price levels that are used, and inflation deflator, we look just at volumes of products that are produced rather than values. Volumes are a little less prone to smoothing, shall we say. And so you see a broad selection of different products here, from infrastructure related to property, transportation, consumer, et cetera. And the just extraordinary event of January, February 2020. Already 2018 and 2019 had been a very tough sailing for the Chinese economy as it worked through a period of transition really toward a future that it had to be figured out. But we've really seen the steepest downturn in modern Chinese history since 1978. And these numbers that go through the end of February are a pretty similar picture actually in March. We have purchasing managers indices data for March that suggested that the levels of activity were only about 0 to 2% better in March than things had been in February. So not really that much recovery thus far. I'm going to show you a couple more detailed looks at different aspects of this in a second. But let me also point out that this week, starting today and then Friday, we'll get more complete first quarter data reported from China. So you'll notice that the commentary, it seems to be going into high gear later this week and telling you how the Chinese economy is doing based on the official numbers. This is the point in the annual cycle where we get those first quarter reports. And so look for that from this weekend. I think they'll probably tell, a slightly better than expected story, because that's the story that the leadership wants to tell. It would be not credible to say that everything is coming up roses right now. But just a little bit of good news goes a long way in the environment that we're in. But that said, not all is well, I would say, yet in the Chinese economy. Of all the sectors on the first slide I showed you, you see property in orange there dipped, but not the deepest. Consumer goods had been the deepest dip. But if you want to know what's the harbinger of things to come in the Chinese economy, you really have to look close at the property sector. That is arguably 12 or 15% of the entire gross domestic product of the country is related to property. It has been the singularly important engine of GDP growth in China for decades. And without it, you can't really tell a bullish China story. So here we have a closer look at property sales in 2020 compared to 2019. So we can see how bad this year has been relative to the previous year, and the growth rate year on year, the black line. So in the most recent date marked on this chart, the very end of March, growth levels year on year were still negative 30% down from 2019. As bad as that sounds, when you consider what a bubbly time China has had in property for the whole of the past decade, I think there's still some distance to go. And that's what concerns leaders right now in Beijing. That not only is it hard to report a very strong economy without property continuing to do what it had done in the past, but the logic of property still making its way the way in the future, the way it had in the past, is just less and less tenable. I'll point out to you that household debt in China relative to household income is a matter of some concern that is sort of the gating factor on how much more mortgage debt households can take out. In the last crisis in 2008, 2009, the ratio of Chinese household debt to income was about 40%, versus in the United States, it was 140%. The value of household debt relative to income made every year. Fast forward to today, and it's switched around. The Chinese household debt to income ratio is 140%, exactly where the United States was in prior to the Great Financial Crisis 12 years ago, whereas the U.S. has actually subsided quite a bit, and the household's not in as bad a shape as it was a decade ago. So that's a kind of structural reality underpinning how fast China can get out of the situation it's in. Turning here to passenger car sales, one of the deepestly impacted industries in China. It had already been a bumpy ride, so to speak, in passenger vehicles for the past year or so. The downturn in sales of new vehicles this year had been 80%, more than 80% down year on year, and hasn't really recovered from that level of contraction in any meaningful way right through April 20th, still down 50, 60% year on year. There had been initial efforts in China to start cleaning up the new energy vehicles sector, where government incentives had drawn in too many speculative, speculative new energy vehicle manufacturers over the past couple of years. There were 200 or 300 of them, just a crazy number for any scale potential for the future. And last fall, they had started shutting many of those down, rolling them up, telling them they had to go ahead and clean up their affairs. And that campaign of cleaning up new energy vehicles has been softened now in order not to put more cold water on an already dark economic situation. A few industries have bounced back a little bit more. Polypropylene capacity utilization. This is how much the factories that make woven and non-woven synthetic fibers out of an oil feedstock to make plastic products have come back to normal levels of activity. Well, we're not fully back to previous year levels of capacity utilization in the sector, but compared to the picture you just saw in property and autos, these factories producing plastic outputs, as you can see, have come back quite a bit. They tend to be this sector tends to be dominated by larger state-owned enterprises that are not that labor intensive. This industry is mostly big machines processing oil products into spinning out plastic outputs. And some of those are, for example, what goes into making masks. Those are made with synthetic fiber that comes out of this chart right here. And so you see some of these sectors have bounced back a little bit more than others. But to finish up on the China domestic side, I want to end with this chart, which is a little bit of a scary one, in my opinion. We look back a decade ago to China's ability to stimulate its way out of a crisis. And we're looking here in gray at the interest that needs to be paid on debt on an annualized basis, on a rolling 12-month basis, versus how much nominal GDP growth there is in the economy. So if 2020 over 2019, the economy is 15 trillion instead of 14 trillion US dollars, then we'd say there's $1 trillion of marginal growth. But as this chart suggests, there's going to be 2 trillion, so to speak, of payment just on debt service, not even the principal of debt, because of how much debt has been used as a tool to sustain the desired level of GDP growth, say 6% or what have you in past years. This means that the toolbox that was used to get out of the soup in 2008, 2009, the extraordinary stimulus that China was applauded and acclaimed for, is simply not an option today. China cannot do today what it did a decade ago. There are other stimulative things that China is doing, cutting rates a bit, insisting that state-owned enterprises pay their arrears to smaller private sector companies. That's, well, a kind of stimulus, just telling people in the government to pay their bills. But this will not be like the last war in terms of how this is done. I'll finish up here, and just in a compressed way, touch on a few things on the external side for China. First, the duration of the crisis. This is a proxy, the black line, of how much China's central bank is intervening to support the value of the renminbi against the dollar. Well, the good news is that that spike up on the far right means that they're really putting their shoulder into making sure the renminbi doesn't weaken against the US dollar. And that's kind of good for, being supportive of international conditions and avoiding the fear that, a new Twitter storm is going to add even more anxiety to the international environment. On the other hand, it reminds us that investors still think of China as a developing country, not as an advanced economy. And in a crisis situation, when there's uncertainty, they tend to move away from that country's currency and into currencies like the dollar, which are seen as more of a safe haven. And thus, China needs to lean in and intervene more to keep it from weakening, which is what it's been. If it stops doing that, renminbi is likely to depreciate against dollar very quickly, which would have all sorts of implications. I'm sure the Swiss economy would be very interested and concerned about. Next, and I'll just stop with these two. There's a lot of talk about whether we should expect a wave of opportunistic Chinese buying around the world in light of the crisis. Obviously, stock prices and willingness to pay for debt financing have changed a lot as a result of the crisis. Things are cheaper from a buyer's perspective, from China's perspective, maybe. And so there are there's great amount of talk in Europe and in the United States and elsewhere too about whether Chinese firms are going to come out and snap up a lot of assets. And that's making folks nervous, including in Brussels and in Washington as well. We at Rhodium, we think, and we do, as you know, a lot of work on cross-border direct investment flows, that's a little bit overblown compared to how things are likely to play out. Number one, as I said a second ago, domestic financial conditions in China are pretty dicey, and there's going to be a little bit more conservative mindset in Beijing than we saw in 2010, 11, 12, where every Waldorf Astoria looked like a great asset to acquire. But secondly, there's also been this greatly stepped up screening response, as you see in this chart, done by my colleague Thilo Hanneman and Charlie Vest and a group of graduate students at UCSD out in California, actually putting together this chart looking at historic changes in investment screening regimes just in the past couple of years, not just in the US, but globally, not least in Europe. We've seen a very extensive standing up of new investment screening mechanisms that will probably prevent a kind of fire sale story from unfolding in the year or two ahead. We've already seen, of course, this extraordinary downtick in Chinese outbound direct investments in the United States. Here you see the two-way FDI pattern, US into China and China into US in red. The story is pretty much the same in Europe, a little less pronounced, but pretty close to this pattern as well. So a lot of disruptions. We can look to some amount of recovery out of China, but really things are not going to be a very a very strong recovery at all. Nothing like a V-shaped story this year, I would say, out of China. And I'm sure, as Kevin's going to hit, we have a lot of toxic politics in the background that we have to grapple with as well. So, Eunice, thanks a lot. I hope that for the audience.
Thank you very much, Dan. Let me start by asking Kevin the question. After 2 months of lockdown, China has since reopened for business. What are your observations? And given that Europe and the United States are several weeks behind the curve, based on China's experience, what can we expect once we open up?
Well, I think the thing to say is that when you say China is bringing to an end its lockdown and bringing back its return to work, I think the bottom line is there's a big caveat around that. Right now in China, if you read carefully what's happening on the ground, there is a genuine and comprehensive concern by the authorities about what's called a second wave effect of the virus itself. As you would have seen in the public reporting, this is largely because of the Chinese authorities' concerns about the importation of the virus from those who have caught it from abroad, primarily their own nationals returning from abroad. And secondly, there is a particular focus in northern China in terms of cross-border traffic with the Russian Federation. And certainly a heightened incidence of the transmission of the virus in provinces like Heilongjiang and Inner Mongolia. And so this has got the Chinese authorities particularly concerned. Therefore, the idea that China has already, as it were, V-shaped its way out of the virus, before we talk about Dan's point just then about V-shaping or U-shaping or flatlining their way out of the economic dip, we need to understand that this will always remain a double-barreled analysis. The public health reality precedes the restoration of economic normality. So I would simply add that as a genuine and serious cautionary remark to all of our analysis. I think the second thing to point out is that one of the key barometers for a return to normality in China will be what does the country do with its young people? And that's kids at school, and it means kids at university. And at present, there is no real sign yet of a comprehensive return to school or a comprehensive return to college. And this, therefore, remains for me a very significant barometer as well of a high degree of caution on the part of the authorities. And the final point I would make about some of the data which Dan has reflected in, I think, his excellent series of slides just now, is what happens with the differentiation between the activity we see being directed in China's state-owned sector. For example, some of the basic industrial supplies, which were referred to in the earlier graphs, as opposed to what's going on in the Chinese private sector, where property, for example, remains king, but other forms of retail and the services industry remains king as well. And I think we're going to see quite conflicting data between what's happening in the state-owned enterprise sector and the private sector. And the private sector, remember, represents more than 60% of GDP in China. And therefore, I think we're going to have certainly nothing approaching a V-shaped recovery. At best, it's going to be an uneven U, with the big caveat being this lingering concern about second and even third wave effects into the future. I'll leave my remarks there.
Thank you very much, Kevin. As we see around the world, keeping people employed has been a top priority for all the governments. And all the governments around the world has issued large-scale stimulus. And in China's case, in keeping large-scale unemployment out of the way has an even more critical dimension, isn't it? Because maintaining social stability provides legitimacy for the party. But we haven't really seen China apply that much stimulus compared to, for example, the United States or Germany. And Dan had alluded earlier to the fact that China maybe cannot afford it. Could you maybe elaborate a little bit more on that? How much of it is because of the shadow of the financial crisis in 2008, when China spent, I think, 4 trillion renminbi and ended up over-leveraged with excess capacity?
Yeah, I mean, make no mistake, every opportunity Beijing has had to deploy financial stimulus and loosening up on credit conditions to boost the economy, it has absolutely done that longer than it should have for the past decade. And so of all times, if there were any room left to go to that toolbox, I think we would certainly be seeing it right now. China's inability or insecurity in doing that for good reason, given that over the past 10 months, we've had 5 bank failures for the first time since the 1990s, right? Including one last week, the Bank of Gansu essentially went into receivership. So we're now at the point where things are starting to come apart at the seams in the banking sector. And that is sufficient sort of Damocles hanging over the PBOC that they simply cannot use this large stimulus toolbox today the way that was previously used. That's disappointing the world a little bit. They're having to find other ways to surprise us on the upside. And there are great ways available having to do with reform and opening and making a clear signal that the future for China is going to involve a very compatible, globally market-friendly approach, as Kevin and I talk about all the time when we roll out the dashboard analyses that we do quarterly. Kevin, I'm sure you have thoughts on this as well.
Well, I think, Dan, that is absolutely right. The constraints which the Chinese government currently face in terms of applying large-scale stimulus of the type that we have seen deployed in Europe, the United Kingdom within Europe, Federal Republic of Germany, the United States, my own country, Australia, is that the stimulus applied by the Chinese back in 2008-9 was, as a percentage of GDP, probably one of the largest in the world. I was Prime Minister at the time. We did a total of 5.8% of GDP, which was big for global financial crisis standards. The Chinese were much closer to 10. And in fact, the Chinese additional demand provided by that stimulus package back then not only kept their own economy at relatively full employment, but helped drag a lot of the global economy back towards recovery, at least in the Asia-Pacific region. Now that, of course, within Chinese politics left a big overhang as those who succeeded Hu Jintao and Wen Jiabao in the leadership, namely Xi Jinping and Li Keqiang, in the very early days of their tenure after 2012-13, spoke about the 10 wasted years of economic reform going back to 2002-2003. But in addition, the fact that China's good balance sheet had been effectively upended as a consequence of excessive and sustained stimulus, and particularly not just its impact on let's call it the debt servicing ratio, which Dan referred to before, now running at about 14% of GDP, I think, Dan. And then on top of that, you also had the fact that you created a whole series of asset bubbles in the property sector in particular, which in turn translated through into a series of problems on the balance sheets of various banks and financial institutions, which have been loaded up with not just property-related debt, but other debt over the last 10-year period. So there are, therefore, these aggregate constraints, political, because of overreach 10 years ago, substantive because of the debt servicing ratio, which Dan Rosen just referred to, and also therefore a concern that in the uncertain period ahead, they do not want to repeat a further hit on the balance sheets of banks longer term by creating further unsustainable asset bubbles. So these are the constraints they face. But here's one additional factor which makes this of an order of magnitude more difficult than what China faced a decade or so ago. I think the number is something like this. Trade, that's exports and imports, represents something like about 42% of Chinese GDP. So a large part of China's economic growth is, of course, still trade-driven. Less than it used to be historically, when it was a low-wage, labour-intensive, export-driven economy almost as an exclusive model. But still, it's a very significant driver of growth. And when you've had the Chinese economy hammered by the US-China trade war over the course of 2018-19, then this comes and hits a whole bunch of economies which normally import from China. You have therefore got a new significant drag on China's overall economic recovery as well. So the planners in Beijing, particularly the monetary policy authorities, are now ransacking the policy toolbox in terms of what is going to work most effectively to drag China back to positive growth. Though we didn't talk about this before, Dan, my own judgment based on multiple analyses that I've seen is that the Chinese economy will be very lucky to emerge from 2020 with anything much north of zero growth. But I'd be interested to hear your reflections on that.
Yeah, CICC, the best-known Chinese investment bank, had previously had a 6.1% 2020 full-year GDP projection for China, and about 10 days ago conceded to reality and reset that at 2.6, I think they said, for the year, including a deeply negative, double-digit negative first quarter, and then they assumed a kind of V-shaped, pretty strong second half of the year. So the debate, really should be between not so much the first quarter, where everyone has acknowledged the depth of the downturn, and that's a very credible and good thing. Credibility is so important in a crisis like this, as you know, having led a nation through one. The question is whether a V is even worth, talking about, and it's not, precisely as the reason Kevin notes, that China's ability to have a V is contingent on the rest of the world's ability to get out of this thing quick. And unfortunately, we've flubbed it in the US. There's absolutely no prospect of an optimal sort of pathway for us through this virus here in New York City. We're in the global epicenter now. And so, we either row together or sink together, I think. Alas, China's not going to have better than a 0% full year 2020, in my opinion, because the world is also looking pretty dark in terms of how we're handling things.
Now, even if China were to have a large stimulus, what would it be applied to? So in 2008, a lot of the stimulus went into government projects. They built kilometers and kilometers of high-speed rail, among other things. This time around, how would you use it? Because there's already a supply chain issue, isn't it? With the US-China trade war, we're already seeing companies around the world diversifying their supply chains outside of China. And I guess the virus has just accelerated that trend, not so much reducing dependence on China, but bringing supply chain closer to home.
There's a lot to talk to you about supply chains, and I think we should spend some time on that. But just in terms of the close-in stimulus question, I mean, from a policymaker perspective, you just want to shovel money out the door to places where it'll get spent and used, and not just used to patch up your balance sheet or your, pay off debt or that sort of thing. And so for all the debt reasons we talked about before, preventing them to do what they did last time, throw money into infrastructure, for example, they're also showing great concern that stimulus money doesn't get used to buy things from foreign providers, unfortunately, right now as well, I would have to say. But what they are doing very smartly, and the world has a lot to learn from it, is issuing tens and tens of billions of dollars in consumption vouchers and handing them to individual mothers and fathers running households, mostly mothers, handle these things on the household budget. And they have expiration dates. So they have to be used to consume stuff in the next 10 or 20 days or 30 days. After that, they're worthless. So you can't save them or put them in the bank. They will create overnight demand for household products anyway, which isn't going to, carry the property sector through. As we talked about at the top, that's going to be the train wreck of the second half of 2020, I fear. But in terms of all these other household consumer goods, foods, even light electronics, these sorts of things, clothes, we could see a pretty good result from using these consumption vouchers around the country.
That's interesting, because what you're saying is that the world needs to learn to be more self-reliant, not only on the supply side, but also on the demand side, because China just saw that orders from Europe and the United States could just evaporate very quickly.
I think that could just as easily backfire and sink us than save us. If everybody goes back to Zili Gangshang, I think was the Mandarin for self-reliance, then we're all going to be doing just as well as we can sitting on an island by ourselves. Kevin, you've had to thread that needle from a statesman's perspective, and I know you have a lot to say about it as well.
Well, every time I hear in Chinese the term "zili gengsheng," it sends a shiver up my spine. It's the Chinese term for self-reliance, and it got its best run around the racetrack during the Cultural Revolution, which those of us as students of Chinese politics and Chinese economics will record was not one of the more successful periods in China's economic evolution. Let me make two sets of remarks, Eunice, about the questions you raised. One is, let's look at China's optimal stimulus settings and how they could approach this and how they may be approaching it. And secondly, then to take up your specific question about supply chains and self-reliance. On the first, the Chinese, against the constraints Dan and I spoke about before, which is that there is the overhang from the past, and they will be very reluctant to engineer a stimulus strategy of the same order of magnitude than they did last time, even though the objective economic need this time is considerably larger than what we had last time. So accepting that constraint, what have they done? A, they've tried to lessen the regulatory burden on firms, and you see evidence of that, and some concerns about that, particularly when it comes to carbon-related restrictions and regulatory frameworks. Number two, they've also extended to firms a range of taxation holidays, by which I mean these are postponements of tax burdens, not tax cancellation. Number three, you see a level of local infrastructure activity through an issuing of local infrastructure bonds, because what central authorities know, both in China and elsewhere, is that local authorities do have a capacity to get activity turning over quickly, because these are usually local projects with not significant regulatory approval processes. You simply go out and get things done. The fourth one is what Dan just spoke about, which is what's called in Chinese consumption or consumer coupons, which are being sent out to people. I hate to say that the Chinese may be following an Australian precedent here, but in the last financial crisis, controversially, as Prime Minister, I took the decision to issue about 3.5% of GDP in direct payments to households. And that was because when we looked at the prospect of the unfolding great global recession of 2008-9, the advice from the Australian Treasury at the time was, if you wish to have any capacity to either avoid a recession or reduce its impact, you had to hit private consumption. rapidly and immediately because it represents, in most OECD economies, north of 60% of GDP. You can play around with construction and you can play around with capital works by the state. You can play around with the residential housing sector. You can play around with private fixed capital investment, but they are smaller percentages in the total generation of domestic demand. So what we did was pump into that straight away. And since then, there have been a bunch of academic studies done of the effectiveness of those measures in our case, because it's one of the only reasons why we emerged out of the great global recession, not going into recession. We actually pumped that in very early. I think, Dan, the Chinese, mindful of those sorts of realities, are seeking to do the same. I question, though, whether they will feel fiscally comfortable enough to do it in an order of magnitude that they need to. And the final point goes back, Eunice, to your question about where does this go in, let's call it, macroeconomic terms and macro planning terms vis-a-vis China's attitude to global supply chains and its own future export dependence. Now, the seminal debate that was had after the Wall Street crash in 1929 into the early 1930s was whether protectionism should be embraced across the world to protect your local economies from the impact of what was unfolding around the world, or whether they should try and keep the arteries of global trade open. Well, in the 1930s, the free traders lost that argument badly. It happened at the London Conference on the Global Economy, I think, from memory, Dan, in about 1932-33. And as a result of that, what was a very bad recession became a long-term depression. And we know what the political consequences of that were if we study the history of the 1930s. We looked at that again in the global financial crisis. And I remember the resolutions of the first meetings of the G20, I was a co-founder of it, which was a moratorium on any protectionist measure by any member state of the G20, which would be monitored by regular monthly reports by the World Trade Organization about who was offending, because we were determined not to repeat that mistake that would happen to the 1930s. And by and large, that worked. What worries me enormously, Eunice, is if the resolution across the G20 economies today, including China, doesn't emulate the decisions we took 10 years ago, but in fact repeats the errors that were made 90 years ago, or 80 years ago at the beginning of the global depression. That's why not closing the borders to external economic activity is critical if we're going to get even a U-shaped recovery unfolding across the global economy.
On the topic of trade, Kevin, a question just came in from the audience about the phase one commitments of China buying an additional 200 billion of goods from the United States this year and next year. How likely will China live up to that commitment? And what kind of political tensions would it cause, especially in an election year, if they don't?
Well, it's a great question. For my sins, I attended the signing ceremony of the phase one deal at the White House on, I think, January 14 or 15 this year. It seems like 2 lifetimes ago now. It was less than 3 months ago. And those of us who've analysed that closely, and I'm sure Dan has as well, would have concluded that the commitments undertaken in the phase one deal were, to paraphrase Sir Humphrey, courageous. Some would say heroic. Some of the structural changes which were agreed to, not many, but some, were doable in normal economic circumstances. But the thing which was most heroic was the arbitrary figure that China would, in addition to its historical norm of imports from the United States, increase that number by 200 billion US over the calendar years 2020 and 2021. Now, that was huge prior to the coronavirus erupting across all of our countries' public health systems and economies. I would be deeply skeptical, therefore, as to whether China will be in a position to deliver on that. And frankly, given the supply side problems in the United States, which are likely to unfold as a consequence of the virus, the extent to which American exporters could necessarily make that level of increase in what they sell to Chinese consumers. And the final point I'd make about the trade war with the United States is, look, the Chinese are not predisposed towards pouring oil on the fire of what is already a very febrile US-China relationship, in particular, a febrile US-China economic relationship. The Chinese ambassador to the United States, Cui Tiankai, who I know very well, just gave an interview yesterday, I think, on G0, Ian Bremmer's Eurasia Group broadcasting platform. And I looked very carefully at what Ambassador Cui Tiankai had to say about this very question. And he said, to the best of his knowledge, that China was taking every effort to give full implementation to what it signed off in Washington in January. But frankly, I go back to my initial skepticism about the deal in the first place. And as for the phase 2 deal, which were structural changes which the US side were demanding to the Chinese economy and the future role of state-owned enterprises around the world and seeking to place them on the same competitive level playing field as other global players, well, I wouldn't hold your breath for phase 2 negotiations to beginning anytime soon.
Hey, let me just add a quick thought, Eunice. Very much agree with Kevin on this. For China to have had any chance of implementing this phase 1 deal prior to the virus, there would have had to have been a nasty amount of trade diversion from other countries as China bought everything it could from the US instead. To hear that China says it's going to still try to implement the numerical targets for upping US exports in 2020 means that everyone else in the world has a colossal trade diversion problem. If China gets anywhere close to fulfilling that statement that the ambassador made yesterday, it is going to be disastrous for anybody else in the world selling fossil fuels, any kind of substitutable agriculture products, and a myriad other things. Boeing's would win out over Airbus despite the problems Boeing has had the past year for China to try to fulfill that pledge at this juncture in time.
What about a larger global policy response? I know Kevin played an instrumental role back in 2008, negotiating a global policy response among the G20 to solve the financial crisis. If we were to do something similar today, what could that policy response look like?
Let me speak briefly about that, and then I'm sure Dan has reflections as well, given it's still within recent economic history. You see, the lesson of 2008-9 was simply this: whatever actions we took domestically to stimulate our economies back to health, whatever actions we took domestically to stabilize our domestic financial institutions through bank guarantees and the rest, would ultimately prove to be useless if these were not replicated by the other major economies in the world. And the reason for that is trade and international capital markets. So the logic then applies today as well. The problem since then has been that the G20 has become a weaker institution than it was, regrettably. The same machinery exists, it simply hasn't been politically deployed as early enough or as rapidly enough as it needed to be. One of the disappointing things that the United States did not immediately convene an emergency G20 session as soon as this thing began to hit, even when it was just confined to China. A global compact could have been rapidly agreed on a global public health response, elevating whatever work the World Health Organization was doing at the time, turbocharging it with political capital and then financial capital in order to, as it were, contain this thing much more effectively than has proven to be the case. I'm sorry, I'm back. The second point is that back in 2008-9, as I just indicated before, a critical decision that was taken was to ban protectionist action by states. In the G20 virtual summit, eventually convened by Saudi Arabia, not by the United States, only a few weeks ago, no such decision on protectionism has been taken. That's regrettable. Thirdly, what we did back in 2008-9 was we agreed on an aggregate global number, which was the total quantum effect of global stimulus, fiscal stimulus. That had a huge effect on calming markets. And finally, what we did, both through the G20 itself and its direct financial arm, the Financial Stability Board, was to embrace a series of measures by central banks in terms of bank guarantees, also ensuring international liquidity access was made available through to the US Fed, so that this combination of actions on trade, on fiscal stimulus, and on coordinated monetary policy action and bank support send a clear message through to markets that there is a way through this, and it broke the fall. Unfortunately, so far, the only element of those actions that I see being embraced is the level of collaboration still occurring between the Financial Stability Board, also through the Basel Committee, and furthermore through the IMF. And one important signal that in fact this machinery is still working is automatically the decision by the IMF to extend an emergency $1 trillion loan facility. This is 4 times what was eventually agreed upon back in 2008-9 by the IMF. And secondly, work now being done by the G20, the FSB, Financial Stability Board, and the Basel Committee, I think, on what will now unfold in terms of a compact on, I won't say sovereign debt forgiveness, but sovereign debt leniency to emerging markets who find themselves in difficulty in terms of standard loan repayments, particularly to sovereign borrowers around the world. That is an important measure right now, so we don't end up with a sort of out of left field sovereign default, which then triggers a broader crisis in the financial system. So far, we've got a public health crisis. So far, we've got a real economy crisis, but we don't want it to actually metastasize into a crisis in the global financial institutions.
And in terms of sovereign debt leniency, how is the current situation in China affecting its grand BRI plans? Are they going to be even more lenient with the debt? A question that came in from the audience is, what is happening to China's BRI credits in light of what is happening?
Let me say 1 or 2 quick things, and then I'd like to hear from Dan. On the BRI front, my judgment would be, and I understand this is the case, there's a lot of blowback into Beijing right now from BRI states saying we need a combination of debt postponement or debt forgiveness, because we're not about to go down the Sri Lankan road and surrender a sovereign asset. That's the first point. The second is, encouragingly, I understand through the deliberations currently being undertaken through the IMF and the G20 finance ministers, which includes both China and the United States, is that on this broader compact I referred to before about debt forgiveness, debt postponement, debt holidays for any sovereign states running into debt repayment problems, is that China is a constructive part of that negotiating process. And as a consequence, China is not at this stage standing out to one side. So I think that is something we should take some confidence in.
A couple more thoughts on the BRI question. A very large share of what China reports as its Belt and Road outlays this year is really just going to be debt renegotiation of necessity. It's really important, as Kevin just pointed out, that China do that as part of the multilateral process, Paris Club preferably, I think, especially concerned with those poorest countries out there that obviously are not in a position to service their massive new debts to China and others under the present circumstances. So that just has to be a demonstration of China's readiness to be a responsible global actor, and I think they'll manage to satisfy expectations in that regard. But that means that this is actually going to be probably more of a pause on China's Belt and Road program growth than it is a year for that to be bolstered. I just don't expect that to happen. It underscores that a big part of what's holding us back from a better global response was that last time around, 2008, 2009, we all still pretty much had confidence that we were going to ultimately work with the same playbook. Everyone was ultimately convergent on the same basic set of OECD, shall we say, advanced economy norms of how you had to organize your economy. China wasn't there yet, but it was, fairly generally understood that China intended to be more convergent with that set of ideas in the future. Fast forward to today, and there's this great coming apart globally as to whether we all are still impelled in the same long-term direction. And so we have these ideas of a kind of different state response to the current situation. Head of Competition Commission in Brussels saying European firms maybe should be taking national stakes in their key companies as a way of preventing other countries from coming in and buying them in this crisis circumstance, for example. That's just unthinkable a decade ago that would have been seen as part of the necessary response. I think back to my study of the London conference that Kevin Rudd referred to a moment ago. Sadly, it was FDR who torpedoed it over the issue of currency stabilization. The Europeans at that time said we have to first stabilize currency dynamics so that we can all, sort this out. And that seemed like too much statism to even the most socialist American president in history, really, Franklin Delano Roosevelt. Take that in today's context, and if we don't work together because we're frightened the other side is going to reshore more than we do, and that somehow our side will come out of this at a slight disadvantage, then we're going to let the common boat we're in sink while we're arguing about who's going to have a better cabin once we get past the icebergs, I think.
Thank you very much to you both for answering all these questions on the economic impact. We have about 5 minutes left. So let me ask you both for a general question. What is the impact on China's international image? I mean, of course, China suffered a credibility crisis due to its early missteps of how they handled the crisis, how they handled the situation in Wuhan. And then they turned around from being the source of the problem to becoming the solution. I mean, they sent products around the world, they sent expertise with doctors and nurses. They showed that with decisive action, they were able to contain the virus with very few deaths compared to the size of the population. I mean, even though I would argue personally that that was done first and foremost to gain credibility domestically, to stroke nationalism among the Chinese. But whatever the motive is, we have seen governments around the world adopting some of China's heavy-handed policies. Not only lockdowns and quarantines, but also, things like using drones to monitor the population, contact tracing, which has raised suspicion before. And now we heard that Apple and Google are jointly developing an app along those lines. Would this lead to more general acceptance of the Chinese way of doing things?
Thank you, Dan. A few remarks on that. I think there's been a lot of overexcited commentary, particularly in the United States, but elsewhere in the collective West, that what has been the monumental, as it were, what has been the monumental domestic failures associated with the US response to the COVID-19 crisis, and the inability of the United States to play the traditional global role that it's played in previous crises, which is coordinating global action, that by definition this results into an overall international relations win for China. I have a slightly different view of this. And that is that through this crisis, we see both these great powers damaged significantly. The US, for the two reasons I've just referred to. And as for China, the ham-fisted way in which some of the Chinese propaganda authorities started to try and attribute blame for the origin of the virus to the United States Armed Forces, frankly, led to just incredulity around the rest of the world about that particular claim. Furthermore, on your point about Chinese medical supplies, whether it's PPE, protective personal equipment, masks and gowns and gloves, etc., or ventilators, the truth is China's overall supply to the rest of the world has represented just a small proportion of total demand for these overall requirements felt by both developed and developing countries around the world. And so therefore, when you add to that also some pretty basic and I think quite terrible racist reactions against often overseas Chinese communities, this is ending up with a much more, as I say, a much murkier picture than the neat geopolitical summaries that I see from people trying to come up with their own definition of a profound Suez moment. End of America, start of China, death of American model, triumph of the Chinese model. I think both these models have actually taken a big hit as a consequence of this crisis. Dan?
The only thing I would add is that, you said it felt like 2 lifetimes ago. I think, Kevin, just January 15th when that phase 1 deal was signed. It's been a couple months, and we're only a couple months into this, and there's many months to come, sadly, where the global narrative is going to get rattled and shaken further. I think it's probably too early to tell how China comes out of this, how the catastrophically bad policy response of the United States, both at the state level in many cases and at the federal level, of course, how that is remembered by history as well, is a story that hasn't fully been written yet. And the butcher's bill is going to shape the narrative, sadly, in the weeks and months ahead. And we'll just have to see. I think one lesson from history we should have in gold written on our doorframe is that the more data transparency and truth and objectivity in the midst of the morass, the better off you'll be afterwards, and the less harshly history will treat you. And both in the U.S. and in China, there are still shortcomings in terms of frankness, I would say, and clarity on the data side, both in terms of the virology and in terms of the economics. And so, alas, we don't always learn from history well enough. And we'll just have to see how the story gets stitched looking ahead.
Great. Kevin and Dan, thank you so much for your time and for sharing your insights. And thank you for the audience for your undivided attention.
Thanks very much. Good to be with you.
Thank you. And great to be with you and with you, Kevin.
Thanks, Dan. All the best.
Thank you.